policymakers across all political parties. We know that the recovery is most importantly an economic one, but IPPR is also doing a huge amount of work around making sure it's also a fair one. So we published a report last week, Prosperity and Justice After the Pandemic. The Centre for Economic Justice that I run was founded in 2018 to take up the work of the IPPR Commission for Economic Justice, which really took a structural perspective of the UK economy and how it can be hardwired for justice and fairness. We make the case in that paper that stimulus and financial recovery is absolutely essential, but it's also essential that we think about making sure that we remedy some of the inequalities in our society that the coronavirus has so brutally shone a spotlight on. One of the things that we pull out in that report is the effect of firm debt and debt, particularly that of small firms. As we all know, the UK Treasury was incredibly quick at rolling out a scheme to allow firms to take on coronavirus support loans administered by banks and the financial services sector, which allowed some of those companies to survive. They simply wouldn't have survived otherwise. And we also know that bouncing back and recovering from the pandemic means investment. The three main priorities that the government talk about are levelling up, making the UK a science superpower, and achieving net zero. And all three of those things will involve investment from both the private sector and public sector. And the UK financial sector will presumably be a core part of that. And I'm really looking forward to hearing from our panellists today around how they think that can happen. So the questions that we'll be discussing are as broad as how has the financial sector supported businesses through the pandemic and what's its role in the UK's recovery from COVID-19? What's the right mix of public and private finance in the future industrial strategy and how can they work together? And also maybe thinking a little bit about Keir Starmer's remarks in his essay for the Fabians around what a partnership or a new partnership between government and business looks like, specifically for the financial services sector. So we're joined by an excellent panel today. First of all, we have Helia Ebrahimi. Helia is the economics correspondent for Channel 4 News. We're also joined by Sarah Boone, the Managing Director of Corporate Affairs at UK Finance, and Paul Thwaite, the Chief Executive of Commercial Banking at NatWest Group. We hopefully will be joined shortly by Rupa Hook MP, who's the MP for Ealing, Central and Acton, and she's a member of the All-Party Parliamentary Group for London as a Global City and the APPG for London Planning and the Built Environment. So, Rupa.
Add on a bit of
It was perfect timing. I was just summing up your introduction, so thank you for joining the panel.
Thank you.
I'll give you a few minutes. I'll put you last in the lineup, so you can have a few minutes to settle and collect your thoughts. But I'll quickly run down the panel, and we'll have maybe 5 minutes per person thinking about the key questions, and then we'll throw it over to you, the audience, for some Q&A. So first, Paul, I wonder if I can turn to you.
Yeah, of course. Thank you, George, and thank you for the invitation. Good afternoon, everybody. It's very good to be here. And thank you to UKF and IPPR for putting on this event. It's very much appreciated. When I think about some of the questions that you posed, I think we'd all recognise that the last 18 months have been incredibly difficult and stressful for many things, but certainly for business. And I certainly have seen that. And I think I have nothing but admiration and praise for how business owners and entrepreneurs have faced the last 18 months, ensuring that their businesses survive. I do think, as you alluded to, that the banking sector, with the support of government, stepped up considerably and was determined to do everything that it could do to help companies bridge through the pandemic. Government schemes and government lending was one important aspect of that, but there were also other important aspects such as extensive payment holidays on mortgages and business loans, extensive advice to all sizes of business during the course of the 18 months. So I think society pulled together, including the financial sector, to help businesses of all sizes and shapes. But as the focus changes really from surviving the pandemic to, I guess, recovering well, I think we do have to confront that there are some inevitable legacies of the last 18 months. Indebtedness, corporate indebtedness, is certainly an issue in the context of small and medium-sized enterprises and mid-sized enterprises. At a system level, there's now 25% more lending in the system. So that's something really significant, and that debt needs to be serviced over the course of the next decade. There's also been some fundamental structural change. I think we'd all recognise that just with our own consumption patterns over the course of the last 18 months. But I do think some of those structural changes have long-term consequences for the economy. So I think what's crucial, George, is that we think about what a broad and inclusive recovery could be. I do think there's a significant opportunity to unlock latent value in UK PLC and the UK economy. I think that should be focused around the areas of productivity, around management capability, but also removing barriers to enterprise. There are still far too many parts of the population that find it too hard to set up businesses, and they find too many barriers in the ways of their enterprise. So I guess 3 foods for thought to finish from me. One is, how do we deal with indebtedness, and what's the role of debt versus equity? I think that's a key issue for UK companies. Secondly, how do we ensure that companies can get sufficient investment in R&D to make sure that we don't choke off any recovery as they service debts? And then thirdly, the opportunity that's afforded by the climate crisis. And I think the transition to a low carbon economy can genuinely be turned into an opportunity to support business. So that's 3 foods of thought from myself.
Great, thank you, Paul. And Sarah, over to you.
Oh, thank you, George. Just to warn you all, I've got the sun right in my eyes. So if I go completely off text, you'll know why. It's nothing to do with my preparedness, I promise. So I just want to say thank you, George, and IPPR and my fellow panellists joining us for this, I think, really interesting and timely discussion. Obviously, as the representative from UK Finance, I am just going to spend a few minutes talking about the financial services sector and its importance to the UK economy. I think the key thing for me is around the open and innovative nature of financial services in this country. The UK financial services sector employs 1 million people across the UK, and they're not all crammed into the city in Canary Wharf. That's across the UK. 2/3 of that 1 million people are outside of London, and that's in places like Leeds, Bournemouth, Swindon. I'm just trying to see if I can see any other people in the room. Edinburgh, that is bringing jobs and benefits to those communities. So I think when we talk about financial services in the UK, this is not just about London. Obviously, the UK financial services sector is a huge contributor to the exchequer, providing £1 in every 20 of total tax receipts. And the UK is also the top exporter of financial services. So the trade surplus was 60 billion in financial services in 2019. So it really is a key sector for the UK. We are here to talk about the future of financial services, but as Paul said, and George, it would be absolutely remiss not to talk about the pandemic and the last 18 months that we've all lived through. I think, for those of you who, Helia and I were reflecting just before, who've been around since the financial crisis, not to age us, one of the things that has really demonstrated through this pandemic is the resilience of the financial services sector through this crisis. And why is that important? It's important, as Paul said, because of the support that the financial services sector has been able to offer businesses. So the financial services sector has provided over £77 billion of support and loans to 1.6 million businesses, small, medium and large, across the UK. And that's big numbers, but what does that really mean in practice? That's Perspex screens in shops so that people feel safe when they do their shopping. That's helping small businesses who may usually have dealt in cash move to more of contactless payments. So this is not just about protection from the shock of the coronavirus, but it's also about helping businesses innovate through the crisis. The sector has also been supporting customers through a variety of forbearance measures, whether that's mortgage payment holidays, credit card payment holidays, additional overdrafts, millions and millions of which have been provided. But the sector itself has also innovated through coronavirus. So, for example, the sector has been supporting millions of customers to become digitally enabled, teaching them how to use things like apps, online banking, shopping online safely, and I do stress safely. And for those who don't want to use digital technology to pay for things, One of the innovations that has happened during the crisis is that the financial services sector has been delivering cash to vulnerable people's homes, people who were shielding and couldn't get out to a cash point. And they've also been providing prepay cards for carers so that people can go and buy shopping for those who are shielding. So there have been innovations as well as just protection through the crisis. And one thing I'll add here, and I'll definitely come back to this in questions later, is all of the work that financial services have done during the coronavirus pandemic can only have been achieved through a really concerted effort working with government, regulators, the Bank of England, to try and find solutions that have worked for the economy, for businesses and for consumers. But this is a panel about the future of financial services, so I should probably talk a bit about that. So looking to the future, post-Brexit and hopefully post the worst of the pandemic, this is a real time of opportunity for the sector. With Brexit, we have a real opportunity to change the rules and regulations that surround financial services. Now, just to be clear, I'm not calling for a bonfire of regulation. My entire career, apart from this year, was at a regulator or at the central bank. So I'm a big fan of regulation. Some of you in the room will know. But what this is a real opportunity is to look at, now that we're outside of the EU, look at what the rules and regulations should be to make the UK financial sector work most effectively. And we've already seen some of these reviews been announced by the Chancellor. So we've seen the Lord Hill review, which the sector absolutely welcomes, and various other reviews, including the wholesale markets review. And these are sometimes quite techy, but they are trying to put in place the conditions for the sector to succeed in the future. I'll just mention three points that I need to cover just in terms of thinking about the future. One is around the international nature of financial services. And this is something that's been talked about a lot, but it is worth mentioning. The UK is the leading global financial centre in the world, or certainly one of them, and there is a huge amount of international rivalry that we see, whether that's coming from places like New York, from the emerging markets in Asia, or from our European neighbours. There are a lot of different countries vying for some of our business here in London and in the UK. So that's something that we really need to take account of when we're thinking about setting our rules post-Brexit, to make sure we are competitive. And that's for firms in the UK, but also for firms outside the UK who want to do business here. And the second thing I'll mention, which has already been covered, is around sustainability. This is the year of COP26 in Glasgow later this year, and there has been a real effort by the financial services sector to think about our net zero commitments, but also generally how we put green finance at the heart of what we do. And this is something that is only going to be more of an issue as we look to the future. So I mentioned that. And then the final thing I'll mention is around innovation. The UK is a nation full of innovators, and financial services is no exception. We saw that during the crisis, we've seen that over the last 20 years. And fintech is, again, one of the jewels in the financial services crown in the UK. And we absolutely welcome the work that was done by Ron Khalifa earlier this year to look at the conditions to make fintech thrive. So I think I'll probably finish there by just saying, for me, when we think about the future of financial services, it has to be a future that works for the economy, but works for businesses and consumers as well. And I think that's something that I'd be really interested to explore with you guys.
Great, thank you, Sarah. Thank you so much. Helia, over to you. Also blinded.
Suddenly blinded. I think it's been quite an interesting time. It's the best of times, the worst of times for finance firms. On the one hand, it follows Brexit, which has caused huge dislocation for firms and for their whole existential experience of the city. On the other hand, banks didn't cause this crisis, so they're jubilant. They've been part of the solution rather than part of the problem, as was the case in 2008. But the question is really, where does the city go? Where does financial services go? And Sarah, you were talking about innovation. We're very good at innovation in this country, and in finance that has meant fintech has thrived, crypto's thrived, peer-to-peer lending has thrived, green finance has thrived. But, you know, because I'm a journalist and because my job is to be cynical and to ask questions, I'm reminded of the Paul Volcker quote, the American economist who ran the Fed in the 70s, who said, you know, the only good innovation that's come out of finance is the ATM. After that, it's all risk and trouble. And, you know, this is the difficult landscape that government has to navigate and regulators have to navigate. How do you marry up innovation and finance and make it as safe as possible? And I think that's very challenging. And, you know, one of the examples from the pandemic, Paul was talking about the great work that lenders have done in making sure that money gets to the real economy, that the support that we've had from government has actually reached companies, reached people. But we have an example, Greensill Bank. You know, here's this new type of lender, or not a new type of lender, but claiming to be a new type of lender, part of the innovation drive, who is backed by the former Prime Minister, who is accredited by the British Business Bank to provide guarantees, COVID guarantees to real companies. And they're a company that exemplifies, you know, they're on a list alongside NatWest, alongside Barclays, alongside all of these very well-known high street banks that you start to see innovation creep in. There's one peer-to-peer lender, and then there's Greensill. And of course, we know what's happened with Greensill. And it just exemplifies for me the difficulty you have in making sure as policymakers that you're fueling growth. You want the UK to be the centre of growth, but how do you do that in a safe way? And I think just on green finance, it's really interesting, it's fascinating, because obviously this is the big challenge of our time, of our age. And there's a lot of money that's going to net zero at the moment, you know, huge amounts of money. We had, just last week, we had the Treasury launching a £10 billion bond. I think it was 10 times oversubscribed. I mean, amazing demand for it. The demand was so high that it was priced better for us, for the taxpayers, for Treasury. We got our debt cheaper because so many people wanted to buy this green bond. But there is a difficulty. You've got, I think the figures are something like there's $200 billion of money going into green bonds at the moment. But just last week, same time as the Treasury launched its green bond, the Bank for International Settlements warned that the growth that you're seeing in green bonds, in CSG bonds, is very similar to mortgage-backed securities before 2008. And again, you see the problem. Anything that grows very fast, and finance has a habit of growing fast when it's successful, poses a risk. And for policymakers, at a time of big change, like we are moving towards at the moment in terms of going to net zero, when the city is trying to, you know, recreate its identity and using green finances as one of those pillars, it's a huge opportunity, but also there are pitfalls and there are risks. Great. Sorry, George, I'll end on that.
No, that's great. Thank you, Harriet. I'm sure we'll come back to plenty of that in the Q&A. And Rupa, finally, I'll hand over to you.
Yeah, look, I'll stand up. You still can't see me, can you? Yeah, I feel somewhat of a fraud being on this panel because I'm not a high finance kind of a person. However, I do represent 75,000 constituents in a suburban seat in London. So all the points made about the importance of the City of London, I would say aye to that. So look, I want to answer this question sort of through the lens of the casework explosion that every one of my 649 other colleagues and I have seen throughout this crisis. And, you know, there's nothing like a crisis and a global pandemic to concentrate the mind on many of these things. So, you know, COVID shocks to the financial system. It's been a shock to every system. Worst recession since the Great frost of 1709, is it? And I don't mean, 9 minutes past 5, but 1709. And all these new vocabularies and expressions that we never used before, social distancing, lateral flow, lockdown, with all of its many sort of variations, the failed tier system. Remember that? We'd all be sort of in suspense about what number tier our London borough is going to be in. So, we've seen, again, as has been said, it's been different to 2009, because this has been one where I suppose the liquidity in the system, everyone was better prepared this time. But it's a weird kind of a crisis, because usually if you think of a crisis, it might be a terrorist attack or a cyber attack or something short, sharp shock, whereas this is one that's going to have a long tail. And, I mean, if you read a newspaper like, which I sometimes do just to see what the enemy is thinking, the Tory Graph, they keep talking about how we wean people off COVID socialism. And if you think about it, all these other new things that we've seen, payment reliefs, rates, rebates, these have all come into the inbox. People that don't have physical premises, so they can't get a rates relief. Or the 3 million people, sole traders, who have had nothing. There is a all-party parliamentary group on the excluded, and, really heartbreaking stories of people that have slept in their car or whatever. I think there have been 19 suicides attributed to the non-support of people. So it's a weird one, because some people have done very well if you've been on furlough, some people have not. Again, all the banks, I have quite a good relationship now. Never had this before COVID. So all the big ones, Lloyds, HSBC, we have Zooms with them to resolve constituent issues. Companies who say that, they're not being lent to, they fit the criteria. Zooms that we have with Treasury ministers, that guy Jesse Norman, I think he's been demoted, had a lot of them with him, raising the 3 million. I think their issue was there's fraud issues. I saw him the other day in the building and I said, sorry that you're not in post. And he said, oh, you're too kind, and all this, because anyway. Look, all these other new things, C-bills, business interruption loan, bounce back loans, mortgage holidays, payment holidays. So in a weird way, and I remember, is this a Chatham House rules meeting? No. Okay. Right, okay, I'll go down a different route. Look, some of it...
Sorry to deprive you all of whatever anecdote you're about to hear.
Look, some of this stuff was in our 2019 manifesto, that craziest, it wasn't quite the longest suicide note in history that time, was it? But, apart from the free broadband, which could have been quite handy with all the working from home, putting people's internet under stress, or people that, don't have internet and are doing it on their phone. So it's a weird one. I mean, I never thought in my lifetime I would see the government mandating the closure of huge chunks of our economy. Hospitality, retail, paying wages. Some people saw the whole of The Crown, every series, the whole of Bridgerton when they were furloughed to their sofa. And, it's a weird one because there's been human suffering as well. I think the official figure, we don't hear the death toll figure anymore. Now it's the vaccination rate that's running on the ticker tape on Sky all the time. I think it was 136,000. The COVID Families for Justice, who I met with yesterday, count it 20,000 more, because that's people who died with COVID, not of COVID. So, and again, spending patterns more locally. Supermarkets, they had to, didn't they give away their rates relief, some of them, because they made such a profit? Whereas fuel, well, we can see fuel, it's gone the other way recently, but demand for fuel, travel, clothing, down. So, what am I going on about here? So, what patterns can we discern? I actually think homeworking has been a big deal as well. So that's kept things oiling along and moving that didn't happen in 2009, for example. And just... look, there's a lot of public policy challenges here, and the government's got a big in tray from hell, if you like. They said they would do levelling up, all this net zero stuff, and then the global pandemic on top of this, and we know there are very long NHS backlog waiting lists. So where do we go from here? I mean, I guess everyone's hoping for a service sector revival, but maybe this working from home, these new habits, we don't know what will stick in the new normal. I mean, again, as a constituency MP, some of this high finance stuff doesn't quite fit with what's coming through the inbox. People annoyed about branch closures. I've lost 2 Barclays banks and a Santander throughout all this. And you wonder if this is... being camouflaged by COVID sort of thing, that they're saying that you know, people using the branch is down, but that's because the branch has been pretty much closed or very reduced operating hours. Also, the strange disappearance of Brexit. So, you know, I won a Conservative seat, gained it in 2015 by 274 votes. When that first Theresa May election was announced, I was meant to be a goner. The amount of interviews I did with your colleagues, Hella, on the green outside as the person most likely to go, kept saying, I'll still be here, stronger than ever. Probably didn't sound convincing or convinced. Brexit, my constituents in financial services who wanted to keep their financial passporting, sent that majority to 13,807 the time after, and it's been similar the one after that. So, I mean, again, camouflaged by COVID are lots of things, sort of thing, you know. And I think this government is doing a bit of a shoddy one, sort of saying this was all the global pandemic, when actually there are serious... I mean, if you look at that deal, so-called deal, that was shuffled out in the days between Christmas and New Year, and something that was 5 years of time turned into half an afternoon of debate or something, it was pretty much a no deal for financial services. Most of it was TBC, to be worked out sometime down the line. So, I mean, my worry is that we're losing talent and jobs. I think 7,600 financial services jobs have moved from the UK to the EU since 2016. And we saw some of those big agencies at the beginning shift. And, you know, this for me is a real worry that keeps me awake at night. And, you know, I just think it's a bit of a rip-off that this government presents itself as new. They have been in power since 2010 in one form or another, but they keep sort of saying, oh, we only got in 2019. So yeah, how to wean people off COVID socialism. I quite like the idea of some elements of that it should stay. How to deal with a long tail sort of crisis. And also another thing that I noticed coming through the inbox is this whole buy now, pay later thing. The Klarnas, they're not even regulated by FCA or any of those. Massive rip-off, loads of people falling for it. So yeah, the green thing we were meant to talk about, I mean, obviously climate justice should be economic justice and green jobs and all that, but I'm sure everyone else can go into that. So, yeah, on the receiving end, as a constituency MP, that was some observations, and I'm sure more will come out in the discussion.
Great, thank you, Rupert. It's great to hear how the kind of things we talk about in the panel manifest for the people in your constituency. Okay, we'll switch to questions from the audience. So I think there's a roving mic, and I'll take them in bunches of 3. So I think the gentleman with the red shirt at the back, the man with the pink shirt here at the front. Please go ahead.
Thanks very much.
Could you please say who you are and where you're from?
I'll do that. Are we switched on? Alec Lieberich from Policy Helping. Interesting discussion. Can I really point out that the finance sector, no more than the manufacturing sector, is a monolith. On the one hand, you've got the city, whose job is to basically raise finance for investment. And on the other hand, you've got Mayfair, where the unregulated shadow banks operate. The regulations that took place after the Great Financial Crisis basically changed the investment banks' models from taking a spread, which is very difficult to zero in interest rate environment, to shifting money into alternative investments where you can get 15% on senior debt. So it's very difficult to raise finance in the long term for green investments at 50 basis points above base rate to when you've got such lush rents being extracted from non-regulated entities such as activist hedge funds and private equity funds. So
sorry, what's the question?
Yeah, the question is, how do you regulate
Shadow banks.
the non-regulated shadow banks?
Great, thank you. And then this gentleman here with the pink shirt at the front, when the microphone's been turned on. Oh, down here at the front.
Thank you. My name is Toby Dada. I'm from Greenwich and Woolwich CLB. So my question is around cryptocurrencies, in particular Bitcoin. In my personal opinion, I think that whole thing is a recipe for disaster. and something bad's going to happen sooner or later. And my question to you guys is, what are you guys going to do around regulating it? Because I know when financial institutions start sort of trading it and start getting involved with that, it can get a lot riskier. And also, I haven't really heard anything about sort of what the government wants to do around that. Like, will it be classed as a commodity? Will it be classed as a currency? There's so many questions around it that need to be answered, and I think it is a really, really bad thing that's waiting to explode. So yeah.
Great question. And a third here.
Just to follow up on one more bucket of regulation, we've got a greenwashing review going on soon at the moment, a Bank of England stress test on climate coming next year. Interested in what regulation, industry regulators you'd like to see coming on climate, whether it's capital controls, anything like that.
Great, thank you. Okay, so quite a range of things, although the common factor seems to be regulation there. So shadow banking, digital currencies, and how we can regulate greenwashing, and the Bank of England's role in net zero. Sarah, I don't know if you wanted to pick up any of those.
Sure. I'll give some broad brush remarks, and then if you want to come in, and then I can always come back on the end. So I think, fundamentally, it goes back to what I was saying at the beginning, which is, we don't want to rip up the rules. I think what we need is sensible rules that actually reflect the realities of what we're working in, the place that we're working in. For me, and certainly in our conversations, it's all around risk. It goes back to what Helia was saying earlier. For us, if there is a risk, then we need to look at what the other risks are in the system and think same risk, same regulation is probably the easiest way of thinking about it. So for something like cryptocurrencies, which you're right, huge amount of risk in there, there are also fantastic benefits there. So again, going back to what Helia was saying around innovation, innovation comes with risk. For us, it's around looking at what do we need to do to manage those risks? Because there are some really interesting things coming out around cryptocurrencies. For example, the whole blockchain technology that can be used, for good. But it's trying to understand what the risk is and what the risks are to the system, to customers, to businesses. Because as innovation comes so quickly, sometimes the risk is difficult to see. So I think for me, I would urge the regulators, and I know that there are some in the room, but I would urge the regulators to look at those risks and try and work out that balance between innovation and risk. I think actually on the green side, it's a really interesting question, because I think this is the problem that we and regulators and central banks have been trying to solve when it comes to green. I think talking in a common language, so the work that's being done around taxonomies is really crucial here, because I think as things develop so quickly, if one person's talking about it, somebody else is talking about it, and actually they're using completely different language, people don't understand what the underlying risk is. So, I think that is what I would urge the regulators and central banks to do. But it's not an easy challenge.
Yeah, quite a few risks thrown up by those questions. Do you have any thoughts?
I think it's fascinating. I'm interested to see how Paul thinks about it, because obviously shadow banking does what you do. It's basically they've taken your
and more,
and they've taken a big chunk of what Paul and traditional lenders have done. And I think after 2008, what happened with regulation is that some parts of the lending market just simply fell outside of regulation. And you're talking about shadow banking, and as you said, it's grown massively. Greensill, a great example. This is an area of lending that is. It's not that they fell short of regulation; they're just not regulated. And can that be right? And I think the difficulty is, how do you do that? How do you get up to speed? How do you? And again, as the journalist, I'm fascinated to see how an operator, do you go there and say, well, hang on, this is not fair. We have to jump through X and Y hoops, which I think lots of traditional lenders do think, and yet we're being, I guess it's an unfair advantage that these operators have. On the greenwashing, which I think is going to be one of the big themes of the next few few years. Yes, the taxonomy is welcome, but my God, it's the minimum. You know, just a basic vocabulary so we all know what we're talking about when we refer to a green investment is the basics. That should have been dealt with. And I think a lot of the hopes from what the Bank of England were going to do are not going to materialise in the way that campaigners had wanted or wished for in terms of capital requirements. But it's a move in the right direction. It's definitely a move in the right direction. I was listening to a podcast the other day of one of the sustainability banks that was talking about you need a sustainability rating for each product. That's what we'd like to see. So that when your bank tells you this is a green ISA, you have a bit more clarity about, well, what does that mean? Are you just planting a bunch of trees and, you know, and now this is a green ISA, or what is your deliverability on green? And of course, the other thing that we hear from campaigners when we do stories about green finance is that the risk it creates about net zero on the macro level is that people think that their green investing is somehow cancelling out carbon emitting, capitalism, which it isn't, obviously. And I think that is the kind of difficulty that regulators, that operators, and consumers are going to have to grapple with over the next few years.
Do you want me to add a couple of things to Helia's questions? So, Alex, to your question, your underlying premise is absolutely correct. Ultimately, the financial crisis and the changes in regulations, in effect, changed the operating model of corporate banks and investment banks. So what does that mean? The reality is now you have a shadow banking sector that is really substantial in scale, and you have a core banking sector which is very transparent, which carries very high levels of capital. I speak for NatWest. We have, for those who are into the technicalities, a core Tier 1 capital level of 19%. That probably compares to around 2% pre-financial crisis. So you have banks with incredible amounts of capital, which provide security and resilience, and actually have afforded the support that we've been able to provide during the pandemic. You also have liquidity. Liquidity ratio is running at 160, 170%. So I would draw the contrast between the core banking sector and the non-banking sector. I do think there are risks presented in that. The challenge, I think, with the non-banking sector and regulating it is, or the argument presented is that both capital and people will flow depending upon the regulations. So if you don't have a global approach to regulation, that you alluded to Mayfair and hedge funds, the reality is, based on my experience, without a global approach, in effect, those operations will migrate to a accommodative regulatory environment unless it's global. So I think it's not just a UK challenge. I think it's a global challenge. On the subject of green and your question, Sarah, around the Bank of England and the climate stress test, we really welcome that. It's been a really good exercise, actually, across the major banks to truly understand the climate risk within the balance sheet of large banks. It may surprise some in the audience that, in effect, we now run a carbon budget or a climate budget. We are aware of the emissions intensity of our assets on our balance sheet. Ultimately, it's about allocation of capital. So we want to allocate capital to lower emitting assets rather than higher emitting assets. So I actually think it's a force for good. What I would say is, though, it's not a kind of one-off dopamine hit. It needs to be a systematic approach to climate stress testing so that we can understand the underlying risk in the financial system, and then over time, obviously, reduce the climate risk within balance sheets and help people support. There hasn't been much comment on crypto. Maybe we'll come back to that. I think it's a big topic, but I didn't know if you wanted to come in.
Yeah, apparently the Central Bank of Ukraine has become the first bank to properly regulate Bitcoin. So I don't know if we should...
Good luck with that.
Yeah, nick something, take a leaf out of their book, copy and paste what their strategy is. But no, I totally agree that if these things just collapse like a pack of cards, you want... Yeah, I mean, cryptocurrency, I think it has been regulated elsewhere, other ones before.
Well, China,
but,
I think.
Yes. So, yeah, no, not an expert on these things. And greenwashing, I agree, there needs to be sort of commonly agreed definitions and standards. But, I mean, it's a common doorstep thing. Again, London boroughs have tried to implement things like low traffic neighbourhoods, all this active travel stuff. And a traditional retort back on a doorstep is, oh, it's the big companies, they need to do it. You know, what is my personal carbon footprint? What difference will that make? It's the people with the oil rigs, it's China, blah, blah, blah. So, I mean, if it is happening from the big boys at the top, that can only be a good thing.
I thought you were going to say then that shadow banking was regularly came up on the doorstep, but maybe not. Sarah, I don't know whether there was anything else.
Yes, I mean, I think the final thing I would say actually on crypto, having heard the rest of the panel, is, and it kind of does go back to the point I was making about understanding the risk. You know, a lot of consumers, a lot of people are looking at crypto and thinking, wow, this is great, there's huge returns here. And I think we have a real responsibility as a sector to make sure that, you know, we are warning people about not just the dangers of cryptocurrency, but also the huge amount of fraud that is going on in terms of, you know, people pretending that you're investing in cryptocurrency and you're actually not, and really taking advantage of that lack of understanding because it's such a fast-moving subject. And you know, I can definitely bore for England on fraud, so if you do have any questions on that, I can honestly. But I think it is something we really do need to have responsibility for.
Great, thanks all. Another round of questions, perhaps? One here on the floor.
Yeah, but you
Yeah.
can't let them in then, so it's open.
No, yeah.
And the drill on the door is just let them in until it starts, and then what? Let some in. I don't know, how does it work up there?
Yeah, just let them in and dribs and drabs as much as you can. It doesn't
Yeah.
get too boring. Hi.
Hey, but food, anyway.
Yeah, feel free.
So I guess I've seen that BBC.
I'll wait till
I mean, you got to speak across the world during midnight.
Oh, really? What? Yeah, I was supposed to be working. Oh, yeah, I was supposed to work Sunday, but I can't. Yeah, I love it. Literally the same time. He's going to go off the rockers. He's going to go insane. Yeah. Just see your face. I did the same. Yeah.
That's a fresh fruit. Yeah. So, that's what we I'm just drawn to the fact that there's actually fresh fruit, which has been a rarity. Just drop us a line.
Has similar views to that.
Yeah, I mean, not as such, but when the Criminal Finances Act was going through, when was that, 2017, I think before my second election, there was all this stuff for disclosure orders, all this dirty cash that gets stashed in houses. I think I worked a lot with Transparency International and Global Witness, and they had a heat map where you could put in your postcode and see how many Russian oligarchs were sort of hiding all their money in a mansion up the road. I haven't been totally monitoring it, how many of those have actually taken effect, but it was meant to be, that was meant to flush out fraud from the system. But, I mean, the doorstep kind of things are usually, you know, why don't you tax the Amazons, the Googles, the Starbucks, because you and I are paying more tax than they are. So, I mean, that could be a populist thing that is not being gone after. Okay, it's not technically fraud because it's within the rules, but yeah, that should happen more.
I can imagine maybe executive pay does come up, so I don't know whether...
Yeah, so, well, I think, yeah, both, I'm sure it does. I will just come back on the fraud point, because I did warn you that I can bore for England on it. No, I don't think the current regulations are right on fraud. I think we've got a perfect vehicle right now in the Online Safety Bill that is going through, it's going through pre-legislative scrutiny at the moment. When you have a coalition that includes all the financial services firms, the consumer groups, the Governor of the Bank of England, the CEO of the Financial Conduct Authority, the Home Secretary, all behind, and the police, thank you, and law enforcement, all behind including fraud in a bill, then surely it makes sense to include that in the Online Safety Bill and have the tech companies held to account for the fraud that's taking place on their platforms. I think that's an absolute no-brainer. So please see me afterwards if you would like to talk about this more. But so that's my view on fraud. In terms of executive pay, again, I mean, it makes me feel old because I feel like I have been talking about this my entire career, and I've only been in banking for less than 9 months. But I certainly talked a lot about it when I was at the regulator in the central bank. For me, I think it's all around incentives and about creating the right incentives.
The one this morning, not just looking at my school, not my school. So it's more strategy about like, yeah, books are not no. So it's like
taking place is because the big tech companies are not taking responsibility. They're not publishers, as we in the media always grumble about. So they are not responsible for even their ad revenue. So if Google, for example, we did a story last week where Google had put up an ad for someone that was like Goldman Sachs. They'd taken the ad money, and a gentleman who was in his 80s, who thought he was financially savvy. He looked this up. It looked like Goldman Sachs. He got a brochure in the post. He checked online. The names of the bankers were the same. He thought he was up to date. He spends with this bunch of criminals about £130,000 of his life savings. He realizes then it's fraudulent. And he basically, his daughter told us, gave up on life because he was so racked with guilt and shame. And that's the problem with fraud, is that the human impact is immense. People end up feeling like they're culpable, that they are not the victims, they are somehow part of the problem. They were too stupid to realize. They're embarrassed to tell people, and the implications for their life and their happiness is huge. And the gentleman in our story died 6 months after, and his daughter said to us that his dying thoughts were about the money. And his wife and his daughter had to tell him in his last breath, don't worry, we've recovered the money, just so that he could pass away with a modicum of peace. And I think the online bill that you're talking about was really kind of exciting for a lot of people, because all across, regulation, the problem is always global, right? People have been grappling with how do we change this? How do we look at what tech companies are doing and what their responsibilities should be in terms of what you see? And I think this was an opportunity in the UK for regulators to be innovative and say, actually, we're going to be ahead of this. And clearly, tech companies should have a responsibility, especially when they are taking revenues. And we basically bottled it, I think, is the truth. We were concerned that these are very challenging types of regulation. It's very new. These are very powerful companies that have lots of good explanations for why they shouldn't be regulated and they should be outside the remit, and they can't. And I can't remember who we were talking to, but somebody said, surely, all the resources of tech firms could be channeled into finding a way to check these companies, instead of, I think the horror story from the TSC, Treasury Select Committee, was that the Bank of England was actually paying Google ads. It was the FCA. The FCA was paying £600,000 in order to advertise with Google to warn people about other Google ads that you shouldn't trust, and which is a kind of crazy situation to be in. And you had the woman from Google kind of explaining this away as something, well, we've given them some credits, it should be fine. So I think it is another example of how fast our society is evolving, in my lifetime anyway, where all of the things that we do, the way we borrow money, the way we look at news, the way we buy services, is changing so rapidly that everyone is on the back foot. In terms of corporate pay, it's quite interesting that banks aren't very interesting from a news perspective. I'm sure people like Paul are delighted at this. It's the gas companies and Google that are the main enemy at the moment, or main news items. But obviously, the issues around fairness are things we shouldn't lose focus on.
Quick one.
In my mind, this is a blame game. You can blame the technology companies, but this is a failure of regulation, because the guy who actually transferred his savings to one of these risky things had to go through a bank, and that bank is responsible. And the Financial Conduct Authority is responsible for providing the guidance to the banks for those transactions which nobody should risk. And it's quite true that there's all sorts of fraud and advertising about everywhere, but nonetheless, the banking community are totally responsible, and it's their failure of the regulations and the relaxation of all the relaxations by Tory governments all over the world, because we had a fabulous framework.
I think you're absolutely right. I was a huge oversight that I didn't blame the banks as well. The banks are somewhat culpable in this, especially with the push payments, and I think that is something that could be addressed by the banks. But you're absolutely right. They're not blameless.
They're not blameless. And
I don't
the
know if
Glass-Steagall Act actually fragmented the finance industry in such a way that it prevented the finance industry taking the risk as
Okay.
themselves.
We've heard you. I think we've heard the point. Paul, so I don't know if there's anything specific.
You
want to come back on?
I think that the topic of fraud is often very personal and very specific. I think there are lots of heartbreaking examples. What I would say, and I hope this audience would understand, that there is an incredible amount of money and prevention that goes in to trying to prevent fraud. The challenge is candidly that the risk reward for criminals is so out of skew. The risk is very low and the reward is very high. And no matter how many payments that we stop, confirm with individuals that you really want to make this payment, no matter what we do, there are still individual payments that individuals want to pay away. So it's a massive source of frustration for banks. It's a massive source of investment. There would be nobody happier than banks to stop the economic crime that's taking place. But I recognise that there are occasions, I'm sure, where banks could have done more. I'd absolutely refute that. I couldn't leave that on the record.
Okay. No, I'd like to go to another round of questions. You've had your say. Sorry, we're going to go to another round of questions. The lady sat next to you, and then I don't know if there are any further questions. Two more in front of you. Go on, please.
Hello, I'm Alexandra from Starling Bank. Rupa made a very important point on financial inclusion. So I wonder what's the panel thoughts and feedback on whether we could be using more technology and innovation in order to serve those communities, such as Rupa's constituents that perhaps have been let down by the traditional banks, particularly the SME communities in the wake of COVID.
Great, thank you. And then the gentleman, I think 2 rows in front.
Hiya, Oliver Heath from YBS. I think the sector's made some fantastic progress in terms of gender diversity. Women in Finance Charter has been terrific for the sector, and I think fantastic progress has been made. But I just wondered what more the sector can do to support sort of broader diversity beyond women to other underrepresented groups as well.
Great question. And then I think gentleman again 2 rows in front.
David from Hackney North CLP. We're on the edge of a massive intergenerational wealth transfer. It's going to be like £5 trillion over the next 30 years to Gen X and millennials. Do you think that the financial services sector is set up for this new responsibility, particularly given the changing attitudes of younger generations being more interested in impact investing and wanting to do good with their money rather than just hoarding it?
Great group of questions. I couldn't have planned it better. A pivot to fairness as we come to the close of this session. So a question there around gender diversity in the sector, financial inclusion, that we all know COVID has shone a spotlight on some of these issues, and then intergenerational fairness. I don't know, Helia, maybe you want to pick up first or anything there?
I mean, diversity is a huge issue. I can't remember, it was Iceland I was hearing on the news. They thought they were the first parliament I was hearing today. They announced they were the first parliament to have more than 50% women, and then they realised it was a clerical error and they had under 50%. It feels like the kind of story that has been around in my career. You think you're making huge strides and then you realise, oh, it's not that good. And yeah, Paul's boss is a woman, great, but look at what's going on with the Bank of England. I think it could do much better on diversity despite its claim. Other groups, I think companies are grappling with it. Are they taking it seriously enough? I hope so. I think there is a difference to when I was a young journalist and people's interaction with that subject, but not enough is being done, clearly.
And then Rupa, you raised financial inclusion the first time around. Anything else you'd like to add to that question?
Yeah, I mean, I think there is still a demand for the traditional bank, which, as I say, they've been disappearing before my eyes. And there are certain businesses who need cash banking at the end of the day. I mean, where are they supposed to go? I think Santander, I've had loads of closures actually. they said advise your constituents to go to the post office. In Acton, the post office has gone as well. So, there's a big void. And it's befuddling. There's an assumption everyone is online all the time. I've just started doing my advice surgeries face-to-face again. And the first person through the door the other day was a 84-year-old who supports a 92-year-old. None of them are online. They're just befuddled by all this stuff. They're not on their street WhatsApp group. People put things through the door. Because we've heard that, in this crisis, every street now has a WhatsApp group and people are looking out for their elderly neighbours. But there's a whole swathe of people excluded by that. And, businesses as well. And when you have calls with... Again, we've had Zooms and Teams with Barclays and with government ministers. We never had any of that before all this, that we've been able to raise things to. And they're more or less saying these people are dying out. We've done a needs survey of our regular customers. We've reassured them there's 1.5 miles down the road. I think it's assumed that soon they'll... And this also links to the intergenerational justice one. So I was on a panel yesterday night, seems like 6 years ago or something. It felt like loose women, actually it links to the gender one as well. It felt a bit like loose women. They had myself, another, Siobhan McDonough, a colleague of mine, a woman from the Sunday Times, a load of us talking about what we wish we'd known about money aged 20. And I just think when I was 20, sorry, it sounds like I'm boasting, but I'm quite old. I'm a product of the 3-day week. So 1972, if you can do the math. When I taught correlation, it's a set of paired scores. I was an academic before. I used to say you can get inverse correlation. One thing goes up, the other goes down. Hours of electricity, birth rate. In the 70s, 1972, nothing else to do. You're looking at the product now. But I had a full grant. There were no tuition fees. In those days, I was even a social housing tenant in my 20s in a difficult-to-let flat. You can't imagine that now because social housing properties are like gold dust. There's a 17-year waiting list in my borough for them. So, and I'm a parent now, and our own are waiting for us to die until they can get a foot on the housing ladder. I do think there's a serious thing there that apparently 1948 was the optimum year to be born because there was no conscription, good pop music, free love, so all these and equity in the house sort of things. So, I think until we have a holistic way of addressing that, more housing supply, more types of tenure, all those things, some of those traditional Englishman's home is his castle, they've just, they don't exist. And I feel it's stunting growth for younger constituents. And I'm an employer as well. The 1948 generation would not have put up with being a 30-something and in a shared household paying private rent for someone else's mortgage where they worry about who stole my cheese.
Yeah, you're telling me. Paul, I know that in your bio it tells you that you're the executive sponsor for diversity and inclusion. So I don't know whether you want to pick up the gender point, and then I am interested to hear what NatWest can do to address intergenerational fairness.
Yeah, no, absolutely. So on gender diversity, it's interesting, I was looking at the stats before I came. So in our apprentices now, nearly 58% of all apprentices are female, which is interesting, and graduates, it's 55%. So I think to the comments around the gender elements. What's also interesting is within that, we deliberately target underrepresented communities and those who face the biggest barriers to getting into financial services. So I do think through those intakes, we are making a significant difference. We also run a social mobility apprenticeship. We're in our 3rd year of that. That's been fantastically successful. Some of the brightest people in the bank really influencing behaviour around the organisation. So it's something I've been committed to initiating, and I'm committed to continuing. And that's, as I say, it's had a fantastic, I think, ripple effect across the wider organisation. And whilst I'm talking to the NatWest story there, I know there are similar programmes in many of the large banks. So I do think it's very much a strategic topic for large banks, and I do think progress is being made. I think we'd all acknowledge as well that more progress is needed. On the topic of intergenerational wealth, which I think is a fantastic question, often in the industry it's called decumulation, so the decumulation of assets. I think it's really interesting because it plays into a number of areas. First of all, financial capability. So as this wealth is passed on, depending upon the age in which it's passed on, I think financial capability and financial education has become increasingly important, and that's something certainly that NatWest is investing a lot into. But also I think you mentioned impact investing, if I remember the question right. So I think it's also already changing the products and solutions that not just the asset management industry, but also the banking industry offer, because I think it needs to tailor to the aspirations of that community and the funds in which they're recipients. I mean, there has always been intergenerational wealth, and I guess a trickle-down effect. I think your point is it's on a much grander scale than before. So I do think it's fundamentally changing the way in which banks and asset managers and insurers think about the products and solutions that customer group need.
Great, thank you. And then Sarah, I don't know if you have anything to
I think I just add to what Paul was just saying there, and I think the transfer of assets, particularly to younger generations, really is something that banks are competing for products, competing to try and innovate to reach those different types of audiences. So they are constantly on the lookout for those kind of products to serve those people. So I think that's actually really exciting. On the diversity side, I had a wry smile while my fellow panellists were talking. I mean, I think there is a huge amount that has been done over the last few years on diversity in financial services. I think it's undeniable. The amount that's happened in terms of the Women in Finance Charter, the Social Mobility Task Force that's recently been set up. I remember when I started in financial services some time ago, and I was very often the only woman in the room, and that's a very obvious characteristic because I am clearly a woman. But there are a lot of characteristics that aren't so obvious, and I think that we need to talk about them a lot more. And social mobility, I think, is one that's key for me. I will never forget earlier in my career where I was asked where I got my PhD, and I don't have a PhD. And so I was then asked where I got my master's, and I don't have a master's either. And then I was asked where I went to school, and I went to a bog standard comprehensive, and I felt like the smallest person in the room. And I think we really need to do more to celebrate people from lots of different backgrounds working in financial services, because that diversity of thought makes better decisions, more creative decisions, more interesting products, and is a competitive advantage for our financial services firms. And then just finally on financial inclusion, I think there is, again, actually the diversity point leads into financial inclusion, because the more that financial services understand people who come from different types of backgrounds, the more that they'll be thinking about products for those people. So, I mean, one of the things I did when I was at the Bank of England, and have continued to do throughout my career, is go on visits to deprived communities to really understand the differences in experiences with financial services. So, people who are homeless, the difficulties that they've had accessing finance, because for banking that is a competitive advantage, because you can find those things out and then build the products, but they are actually also genuinely doing good, and I think that's the balance for me.
Great. Okay. I think we have time for maybe a couple more questions if there are any. No hands, no burning questions. I have one for the panel. No more? Okay. So go on.
Sorry.
Oh, hang on, the microphone's coming down.
I don't think I need it. Hello, James. Is that working?
Yeah.
Yeah. James Robinson. I'm in a consultancy called Woburn Partners. We touched on it earlier in some of the answers. Buy now, pay later, which I would argue, I've got a vested interest, which I won't share with you now, but I would argue is an innovative form of interest-free credit. I know that's facing regulation. What does the panel feel about how it should be regulated? Thank you.
Right, and my question, just to add to that, some of the conversation that we've just had today over the past 90 minutes seems that regulation is a hot topic, which is pretty much a direct response to the current government's line of bonfire of red tape post-Brexit. So it sounds like that's not the answer, and yet we have Keir Starmer is going to give his speech, and he's talked in somewhat vague terms around a new partnership between the public and private sectors, or between government and business. Wonder if my question would be, what are you hoping to hear on Wednesday? What does that new partnership mean, and how do you interpret that? Because I think you can read quite a lot into that word of partnership. Rupa, those questions to you first, perhaps?
Yeah, okay. Buy now, pay later. I mean, to me, it's there was Bright House. Again, that's a business that's gone from my one of my high streets, and I'm pleased to see that, because their APR rates were like a telephone number or something. There were very large figures there. And again, sort of this, it used to be called the Never Never, didn't it? It used to be HP, and then it's now called Credit. And I would agree with the more financial literacy and let people know what they're getting into. Because again, I've had casework of people who were duped by those. The Klarnas of this world I don't really know enough about, but payday loans, all those things instinctively, I don't know, I'm from a immigrant household where I was told to stay within your means and be careful. So instinctively, I mean, maybe I don't know enough about it that I'm saying it's all a load of rubbish, so maybe we need to talk after. The regulatory framework thing, what am I hoping to see on Wednesday?
What does Keir Starmer's partnership between the public and private sector?
I mean, again, it doesn't necessarily have to mean an old style. With the rail nationalisation question, people always say the sandwiches were horrible in the 70s. Which I just think is a really tough argument, because culinary tastes have moved on. So you don't have to have a sort of old style, 70s style nationalisation, but there are European models of doing public ownership. And so I would like to, I'd like to hear that fleshed out, and I'd like a Labour government to do all this.
Paul? So I think Wednesday and partnership, I think, I guess, a vision and an ambition around, I guess, where Keir would see the country going, and how really he would see large corporations, the public sector working together to achieve some of those bigger goals, yes, whether that's addressing the issues of climate change, whether that's addressing some of the more financial issues we touched on today around financial inclusion, because I do genuinely feel there's a role for private and public on some of those big issues. So charting out that territory, I think would be welcome.
And was there anything on the buy now, pay later?
So my view on buy now, pay later is it's become quite ubiquitous, via a relatively small number of providers. I think when something becomes that ubiquitous, then I think the industry and the regulators should think ultimately about whether that's serving consumers well. And my view is a thorough analysis of, is buy now, pay later serving consumers well? And then that would lead you to the question of, does it require to be brought within a greater regulatory perimeter? And I think there are some interesting examples in other parts of the world where there's started to be some progress on that.
Thanks, Sarah.
So declaring an interest, Klarna are one of our members. They joined us in June. Just bear that in mind as I speak. So I'm not going to talk for Klarna, although if any of you guys are in the room, hi.
Sorry.
Sorry. I think Klarna and other buy now, pay later companies have said that they want to be regulated to the same standards, and they see that as a competitive advantage. I think this goes back to something I said earlier around same risk, same regulation. We have financial services firms who provide buy now, pay later who are already regulated. So it would make sense for firms who are just doing buy now, pay later to be regulated as well. I mean, I would say one word of warning, and this goes, I'm just checking how many of my former colleagues are in the room. The FCA did a huge piece of work on high cost credit. And a lot of those forms of credit no longer exist. There is a reason why credit exists, and it is not always possible for people to live within their means. And particularly for people who are the most vulnerable in society, sometimes they need to use credit, and we shouldn't be shaming people for doing that. And I feel very, very strongly that if we just regulate all of these types of credit out of existence, then what happens is that people will move into unregulated or criminal activities. So, it's the kind of thing that you perhaps wouldn't want to see. So there is a role for credit. The really important thing is that it's regulated appropriately. And Klarna would be the first to say, and have indeed said, that they're more than happy to be regulated. So that's my Klarna pitch. In terms of Keir Starmer and the partnership model, I think we already see a lot of partnership working between regulators, the industry, the central bank, consumer groups, and I think that's something to build on. I think that there can be more examples of dealing with some of the really knotty issues that we've been talking about on this panel, things like economic crime, access to cash, that can only really be solved through that kind of partnership working. So I'm really interested to hear what Keir says tomorrow, on Wednesday.
And Helia, the panel's resident cynic.
I mean, I think on credit, I would just say, obviously, they should be regulated. You know, that goes without saying. I'm always suspicious of any lender, any credit provider who is charging very high rates. I always think that, as a journalist, I look at that and I say, why is that happening? And it's not just buy now, pay later. There's a whole group of credit organisations that, through open banking, deregulation in some areas of banking, have taken advantage of that, and it should be looked at. On the kind of political landscape for partnership, I think what we're seeing at the moment, our current energy crisis, where people are panic buying petrol, where consumers are having their energy suppliers go bust and don't know where they're going, don't feel comfortable. What you see is a lack of partnership between government and business, and that is all the more clear. You know, as you were talking about this, the pandemic, Paul, had brought this era of collaboration where everybody felt that they were pulling in the same direction. Lenders were providing money to the real economy, government was putting the money in, the real economy was trying to go forward, everyone was moving in the right direction. And that is great to see, but you do, in the current energy crisis, you do see the gaps that are created and the huge implications. If you don't have lorry drivers, what's the knock-on effect? Guess what? Everything you have comes to you from a lorry. If you haven't invested in gas containment storage, you know, what happens when you don't have wind? You know, there are lots of problems that mean partnership, and the problem governments have is they're only in term for 4 years. And the problem that the real economy needs is decisions that last decades and decades. And the partnership that I'm interested in, not as a journalist but as a citizen, is what are those big infrastructure choices, and why can't we make them in this country? Because that ultimately governs the standard of life that we have.
Great, thank you. And then we have time for just a few closing remarks from each of our panellists. I think we'll go... unless you...
Yeah.
You may?
Yes.
And then we'll wrap up.
Just a couple of things. So, like the discussion around buy now, pay later often gets wrapped up with payday loans. So it's a very important distinction to make, and interest. So on to take a step back as well, we have basically 3 buy now, pay later products. One of them is regulated; it falls under the Consumer Credit Act. We have 2 that aren't. The 2 that aren't, we charge no interest or no fees. So it's completely for the consumer, even if they fall behind. They will only ever owe the cost of the original purchase. It's funded by the retailer, so that's the model, and it's very deliberately set up that way to provide people with access to very low cost, or in this case, no cost credit. As has been mentioned, we are fully supportive of the move to regulate the sector. We do think the sector should be regulated. We've approached the FOS to ask if we could be members of the voluntary the Financial Ombudsman Service on a voluntary basis. They said that structure doesn't exist right now, so we're working with government regulators to get regulation in place as quickly as possible. So I just wanted to make a couple of those things clear.
Right. Good clarification. Thank you. All right, there's time for closing remarks if you want to make them. Helia.
I have done, but I'm interested in what you said. Do you think? Can I ask this question? Do you think it's unfair?
Okay, we'll split.
Do you think it's unfair? Do you think it's unfair? Do you think our response to Klarna is unfair?
I think it's unfair to put us in the same category as Bright House and businesses which earn money from charging a very high interest rate.
Well, how would you describe Klarna?
The retailers pay the fee, they don't charge any interest. They charge the retailers transaction fees, so it's a completely different model. I don't want to bore everyone else.
No, I'm fascinated.
So ultimately, the way we look at it is, if you fall behind on payments to Bright House or to even a credit card company, you will end up paying interest on that debt, and your debt will get bigger. So those people who are least able to manage their debts end up in a situation where their debt is spiraling. We're trying to do something the opposite. We're trying to do something where we provide consumers with that flexibility, which everybody needs from time to time, with credit, but in a way which helps them get back out of debt by A, not charging them interest, and B, not charging fees, and C, providing them with a clear repayment schedule. So you can't revolve in your Klarna debts. You have a clear repayment debt.
All right. Yeah, it's a beautiful sunny day. Go and talk about it on the beach over an ice cream.
We can all join the Buy Now, Pay Later symposium.
I think that's enough. I think we're okay. Thank you very much. I'd just like to say thank you to the panels, to Rupert, Paul, Sarah, and Harriet. And thank you to UK Finance for making this event possible. I could see your